2018 interim results for regional REITs have been very impressive in our view. The dividend is up 3% on like-for-like 2017. The board have announced that we'll pay 8.05 pence per share over the course of this year, ahead of the 7.85 pence per share in 2017. NAV growth has been substantial, up 8% to the half year, taking NAV to 113.6, well ahead of the 112 pence per share full year estimate, and indeed subsequent sales to the half year, we anticipate further NAV growth in the second half of 2018. Total return since inception November 2015 is 32%. On an annualized basis, 11% per annum, again ahead of our target of 10% plus per annum. LTV has been reduced from a high of 49% post the Conigar deal in March 2017, reducing to just over 47% at the half year, 45% at the full year December 2017, and you'll see from today's results now down to 41.2%, so a 380 basis points reduction, and moving in the right direction for us with a target of 40%. Also in the first half of the year, or just post first half of the year, we've had the bond issue. That was a £50 million retail bond, which we successfully undertook just post half year. The purpose for that bond is to replace the zero dividend preference shares, which are due to mature in January 2019. So 40 million of the 50 million raised will go to replace that, effectively replacing the expensive 6.5% debt with 4.5% unsecured debt. The remaining 9 million of the net proceeds will go to reducing the company's debt further, all adding towards the downward direction of LTV. We have, the activity levels are high. We always said when we came to market we'd be opportunistic, and I think we've been exactly that. So we have been selling assets. We sold 20 assets for just over £60 million in the first half of the year. A combination of good offers, well ahead of book value, and business plans coming to fruition. So we've been in market 3 years now. We are active asset managers. We add value using our asset management platform, as a consequence of which many of the business plans, individual business plans for our assets have come to fruition. At that point, we decided to dispose or hold longer term. So it's been a good market to sell into. The net initial yield achieved on those sales is some 4.9%, so well below our dividend level. And we've been able to successfully replace those assets. We've acquired 7 assets in the first 6 months in 2 separate deals, just over 40 million in total, an average yield of 8.4%. So the arbitrage between the acquisition yield and sales yield is obvious to see, and very accretive to the business. Part of the purpose of the sales is obviously to realise potential gains that aren't being witnessed through valuation. We're simply not seeing valuation keeping up with the investment market, and I think that the only way to achieve those gains is to make sales. Average sales price is 20% ahead of valuation, so quite a considerable differential. Now that clearly, if it's not going to be seen in valuation, the way to grow the company is to undertake sales and recycle capital. We've also been very active post the 6-month results. The intention at the beginning of the year was to undertake the majority of our business in the first half, and these are simply deals that have taken a little bit longer than anticipated and gone over the 6 months. Those sales are quite substantial. We've sold roughly £120 million worth of assets now, so doubling the 60 million in the first half, again achieving an average of 20% over book value. Those monies will be recycled. Needless to say, there's a small impact on income because that income has been sold, and there will be a slight gap before that income is replaced through acquisitions. Our acquisition pipeline is healthy, and we expect that money to be reinvested over the course of the next few months. Part of the reason for us undertaking our business plan in the first 6 months is just the uncertainty, the unknown unknowns, as we call it, of Brexit. Clearly, nobody is quite sure what impact that will have. Our view at the beginning of the year was that it's likely to have an impact towards the end of 2018 and into 2019. Therefore, the bond issue and the sales process was undertaken in the first 6 months. So that's not to say we won't be active in the second half of the year. Indeed, we will be on acquisitions and select disposals, but not as active as we've been to date. When we came to market, we set out to undertake several strategic aims. One was to reduce exposure to Scotland. We're 35% when we came to market, currently 21% of the half year, and post half year sales actually takes us to 18%, getting towards our 15% long-term target. We have looked to increase exposure to the southeast and southwest office markets. That's been a specific policy over the last couple of years, given rental growth and capital growth prospects in those two regions are outweighing those in other regions. 18 months ago, we were buying northwest for the same reason. We do try and look at markets in a strategic way and invest on that basis. So we continually do what we say we'll do. I think we have delivered on every aspect of our business plans since we came to market in November 2015, and will continue to deliver on that basis. I think Regional REIT is well placed. We have extended our debt terms, and our debt is either fixed or swapped, therefore very little interest rate risk. Our average cost of debt is now 3.8%, and 6 years unexpired, and that will increase through a couple of small refinancings to be undertaken in H2, and that will increase to 8 years unexpired and a total cost of 3.5%. In terms of the portfolio itself, we continue to diversify. On acquisitions, we always look towards the tenant base, so that there's as little overlap as possible with the existing tenant base, for the purpose of expanding the number of income streams, individual income streams that make up our rent roll. We have just under 1,000 tenants as at today. We have 150 assets geographically spread throughout the country, and we think that is a risk diversification play by Regional REIT. The other important aspect of that is we look at standard industrial classifications, i.e. where the income is derived from in individual industries. Very important part of diversification, as any economic downturn tends to affect one sector more than another. Therefore, by having such a broad range of tenants undertaking a broad range of services and businesses, again, a risk diversification play by us. So in terms of the future and any uncertainties from Brexit, we think we're far better placed than most to ride out any potential storms. In addition, Regional REIT, we feel, is in the right place. We see continued investor demand for industrial and office assets in the regions, and we think that's only going to continue as investors chase yield. Yields in the regions are still historically high. We're still seeing value in our markets, which is allowing us to buy. And of course, we are buying the unloved, underutilized assets that a platform such as ours is required to increase and improve value, and creating the clean 4 rent checks a year product that the general investment market wants. I think that's been demonstrated by the sales and acquisitions that we've been undertaking. Clearly, sales are much lower yield than the acquisitions. So we're buying well, creating value, and selling well. And I think that will continue. Investor demand is strong. Just touching on occupier demand for a second, I think an important part, ultimately, we are an income fund, and therefore occupier demand is essential to our business plan. That's held up well. We don't see any impact of Brexit so far. We don't know what's going to happen in the future, but again, given the breadth of our tenant base and the quality of our tenants, we foresee that we will be able to withstand anything that Brexit has to throw at us. Occupier demand continues, supply remains tight. We're still seeing little or no new development in our sector. Our office assets are held an average value of £130 per square foot. Reconstruction costs for those offices are ranged between £180 and £220 per square foot, so replacement cost just makes it uneconomic to build. The industrial assets are held at £42.75 a square foot, against a build cost now of £85 plus. So again, the economic drivers there, it just doesn't make sense to develop. So we're going to see little or no new supply in our markets with continuing demand. that's a great position for a landlord. So in summary, we continue to create value through our asset management. I mean, we do have that unique platform with having everything service in-house, from financial management, property management, and asset management, that allows us to take poorer quality, messy assets. So we'll continue to do that. We'll continue to create value. We'll continue to improve income and do all of the things we've been doing for the last 3 years. So from Regional REIT's point of view, we think that we're well placed for future growth and to protect and improve